Thank you for joining us today for this webinar on the Beverage Alcohol Tax Ecosystem. This webinar is sponsored by Avalara. They breathe compliance so that you don't have to. And we have two of their experts here today to share their insights. We have Shannon, who's going to talk about understanding the different tax types, as well as shipping reports and the data requirements for doing your filings. Then we'll move on to Sarah, who's going to talk about the economic nexus and how marketplaces may impact your filing needs. This webinar is pre-recorded, but we'll have a live chat throughout the whole thing. Both Sarah and Shannon are available, so when you have any questions, just put your questions in the live chat and they will answer them as we move along. Now, to get started, let me kick it over to Shannon.
Thank you so much, Kim. We're more than happy to be here. And so I'm going to start with kind of going over what we're going to talk about today. I'll introduce myself and my fellow speaker, tell you a little bit about Avalara, and then we'll jump right on into the topics. So we're going to start by talking about understanding some different tax types and shipment reports. We're going to talk about economic nexus and marketplaces, and managing the returns filings, due dates, things that you may need to do if you're working with us or just on your own. And throughout today, if you have any questions, please throw them into the chat. We'd be more than happy to answer them. So my name is Shannon. I currently work as a tax research analyst 2 here at Avalara. So my job is to keep up with changing regulations, statutes, things like that, to make sure that we're able to file and apply for licenses and do all of those things on time. I used to work in the returns department, but I have now moved over to my current role, and it's a blast. It's really interesting. And this is Sarah. She is the Director of Tax Compliance Services here at Avalara. She's been with us for about 10 years. She is really passionate about our customer service, as well as our accuracy and efficiency. And she's based in Sacramento, California. She also loves to hike and run and do all sorts of outdoor and adventure things. And Avalara, we are all about tax compliance. We do the hard stuff so that you don't have to, especially in beverage alcohol, license requirements, taxing requirements, all of that stuff. It changes all the time. And it changes from wineries to breweries to distilleries. It doesn't matter. It changes all over the board. So we want to make sure that we take care of you and get your tax returns, your license applications, product registrations, all of that submitted correctly, accurately, and efficiently so that you don't have to worry about it. So now, with all of that out of the way, we're going to go into understanding different tax types, reports, things like that. So I want to start today by talking about shipment reports. It's kind of the most basic of the returns and reports that we file. So shipment reports are typically administered and regulated by the whatever state you're shipping to, that state's alcoholic beverage control, liquor commission, or equivalent agency. In a couple cases, it's the Department of Revenue. But in most cases, it's the alcoholic beverage control or equivalent agency. We see shipment reports primarily for wholesale shipments. So that's going to be your shipments from your supplier or manufacturer, meaning, the wineries, the breweries, the distilleries, or your importers, to the distributors in those states. And we see this is the most common type of shipment report that we file. And so almost every state, not every state, because in beverage alcohol, it's never every state, but most states have some kind of a shipment report for wholesale shipments. We also have a few states that allow direct-to-consumer shipping that will have a direct-to-consumer shipment report to summarize the data or to summarize the information about where those products are going in their state. There's a couple states that allow self-distribution as well, meaning the winery, brewery, distillery, or importer is shipping directly to the retailer. And a couple states have a shipment report requirement for that kind of shipping as well. And a few states actually combine these different ship types onto the same report. So it doesn't matter what type of shipping you're doing in those cases, it's all going to be filed on the same report. So what is a shipment report? What does it look like? There's a bunch of data that they ask for, primarily or initially they're going to ask for the licensee information. So this is going to be the business who is doing the shipping, the winery, the brewery, distillery, etc. That business's name, oftentimes the license number, sometimes your address. And that's just to say, okay, this is whose shipment report this is, right? Next would be your recipient and your customer information. Now, if it's a wholesale shipment report, that is going to be the same information. It's going to be the distributor that it's being shipped to, right? So this is their address, their name, if they have a license number associated with them, something like that. For direct-to-consumer shipping, though, the recipient and the customer may be two different people. So, let's say you're wanting to buy your friend a case of wine for their birthday and just get it shipped directly to their house. You would be the buyer in that case, or the customer, and your friend would be the recipient. And so in a lot of direct-to-consumer shipment reports, they want both of that information. That can include the name, the address, some cases date of birth on the direct-to-consumer shipment side, because of course, customer, recipient, either way, you can't be under the age of 21. And that kind of information. And then of course there's invoices. So what is the invoice number? What was the invoice date? The ship date of the product? How much was shipped? What kind of products were shipped? Brand name, things like that. And volume, volume would be your gallonage, your liters, in some cases, number of cases or number of bottles, size of bottles, size of cases, things of that nature. It all depends on the state that you're submitting the shipment report to. And then in a couple cases, especially with direct-to-consumer shipping, it would be, there's 2 states, I think, maybe a few more, that require common carrier and fulfillment house information. So this could just be as simple as, oh, we shipped it via FedEx, or here's the tracking number. Or, we shipped it specifically from this fulfillment house location in Kentucky to the resident in Kentucky, or whatever it may be. So each state's a little different, but there's some common themes throughout. It's just important to know the kind of data that would be required on these shipment reports. Next, I'm going to talk about excise tax. So excise tax is specifically a volume-based tax. So this means it would be on the number of gallons, the number of liters, barrels, cases, bottles, etc. That determines how much tax you're paying, right? The rate is a per volume rate. And so we see this tax primarily on direct-to-consumer shipments. This is because in most states, again, not all states, because it's never all states, in most cases, the excise tax is levied on the transaction between the distributor and the retailer. Obviously, if you're shipping directly to consumers, it's not going to a distributor or a retailer, but they still want to get that tax revenue. So we see excise taxes on most direct shipments in the United States. And then there's a few states where that excise tax doesn't originally go between the distributor and the retailer. It's actually levied between the supplier and the distributor. And so that's when we'll see it as a wholesale excise tax. And then there's the couple of states that allow self-distribution. It would be levied between the supplier and the retailer. And so again, this is based on volume. So most of the time it's something like $2 a liter or $2 a gallon, or that's just an example, right? But it is based on volume. In a couple cases, these returns also have some kind of schedule associated with them, which looks very similar to a shipment report. They want to know where the product's going, how much is going, what kind of product is going, all of that stuff. The same data we just talked about for shipment reports. And then the rates can actually vary. So it's dependent oftentimes on the type of alcohol you're shipping. So wine versus beer versus spirits, or even still wine versus sparkling wine versus hard cider. And then in other cases, it can be determined by alcohol content. So wine over 16% would be taxed at a higher rate versus wine under 16%. And that just depends on how the state laws have set up this tax. We see a couple states that actually have different rates depending on the supplier's annual production volume, right? So if you're a winery shipping into New Mexico, how much do you produce a year? Is it under a certain threshold or over a certain threshold? And if you're, a smaller winery, you're producing less, you may get to pay a lower rate. Similarly, if you're shipping less, once you hit a certain threshold, your rate may be a little higher or a little lower. So these are all considerations. Of course, every state does it differently, but it's something to keep in mind that if you're going to be shipping into a state in the United States, you're probably going to have to pay some kind of an excise tax. Next, we have the markup tax, which is also an alcohol-specific tax, but it is actually gross receipts based. So it functions kind of like a sales tax. It's based on the sales amount, not the volume of the product. But these are alcohol-specific. So we can see these sometimes instead of a sales tax. Other cases, we see them in addition to sales tax. And then we even see them in a couple states that don't have sales tax, or at least state level sales tax, but they may still have this markup tax. Oftentimes, this markup tax is a higher rate than your typical sales tax. So let's say in a state, the state sales tax rate is 6%, but maybe on alcohol, it's going to be 10%. So it would be just a slightly higher rate for these alcohol products. Typically, we see this on direct-to-consumer or retail sales because like sales tax, it's that end consumer purchasing the product. There's a few states that I can think of that have a markup tax. We've got New Hampshire, Kansas, Wyoming, and even Kentucky. New Hampshire is interesting because they don't have a state sales tax, but they do have this markup tax. And so you would have to pay this even though there is no state sales tax. In Kansas, they have what they call the liquor enforcement tax, and it's to be paid instead of the state sales tax. Whereas Wyoming, it's both. You pay their markup tax and their sales tax. And Kentucky's similar. They have what they call, I think it's the wholesale wine equivalent tax, which is paid in addition to sales tax and excise tax. And that one is interesting because the markup tax is paid together with the excise tax. It's all in the same return. So not every state has a markup tax, but it's important to know if you're shipping to a state, do they, and how much is it? This is all stuff that Avalara absolutely can help you with. We file these returns on behalf of our clients every month. So finally, I'm going to go over briefly a high-level overview of sales tax. This is just like your regular sales tax, like you would pay on a t-shirt or a car, although that would be substantially a larger amount, I would imagine. And so this starts with the state level sales tax. And that means there's this base sales tax rate across the entire state. There's a couple of states that don't have sales tax, like Oregon, and Alaska does not have a state sales tax. Neither does Montana. So not every state has sales tax, but in the states that do, it mostly starts with a state level sales tax. Then the local sales tax rates are built on top of that state level. So this could be a county level sales tax, city, and any special jurisdictions, which are typically a smaller tax or smaller rate than your city or your county rate. So if let's say you're going to ship to somebody who lives in the greater Los Angeles area, that could be a number of towns, right? LA is a huge area. And so they would have to pay the California base or the California state rate, the LA county rate, and then the city rate of whatever city they're in. And then maybe their neighborhood has its own rate too. And so you would combine all of those rates to make the sales tax rate on that shipment. It's also, like I said, gross receipts based. It's based on the sales amount, which is interesting. it's like the markup tax, but again, this is across all other products as well. And then direct shippers have kind of an interesting relationship with sales tax. So in the vast majority of states, not all of them, but most states that allow direct-to-consumer shipping, they have actually written the sales tax requirement into the direct shipper law. So the requirement to collect and pay sales tax comes from that direct shipper law as opposed to sales tax law. It's the same sales tax, but the requirement itself is coming from the law. And this is important, especially with all of these states creating Nexus laws over the last couple of years since Wayfair passed. And this essentially what happened is most states already had the sales tax requirement, but there's a couple states like Colorado or Missouri who historically there wasn't a sales tax requirement for direct shippers. But with the passage of Wayfair, there is now a sales tax requirement if you meet a certain threshold. And so Wayfair, haven't mentioned what that is yet. It was a Supreme Court case that the ruling was handed down back in 2018, and it essentially allowed for or set the precedent for states to require remote sellers to collect and pay sales tax in that state. So if you're a shipper from California, a winery in California wanting to ship directly to a consumer in Arizona, or I guess Colorado would be a better example. If you meet their Nexus threshold, their economic Nexus threshold, you now have to pay that sales tax. Whereas before, there was not a sales tax requirement in that state. Missouri is kind of the last holdout for Nexus laws. And that's actually going to change in January with their new Nexus law taking effect. And so where there has not been a sales tax requirement in Missouri historically for direct-to-consumer shippers, there will be starting in January if you meet their economic Nexus thresholds. But in most other states, doesn't matter how much you're shipping, what your sales are in that state. If you are a direct shipper, you will have a sales tax requirement in that state. It just depends on the state you're shipping to, like with anything else in alcohol. Colorado is kind of unique because they just recently created what they call the Colorado Retail Delivery Fee. And so this is a 27-cent per order tax on taxable goods that will be delivered to a resident by motor vehicle. And so it's very unique. We haven't really seen this before, but it is a tax that Avalara supports, and we're able to file for our customers. And it has been pretty confusing for a lot of direct-to-consumer shippers. But if somebody places an order for wine to get delivered to their house, obviously that's getting delivered via motor vehicle. So that would be a taxable transaction in that case. I just talked about Wayfair. Again, Wayfair kind of set that precedent for states requiring remote sellers to collect and pay sales tax in their states. And you can see here, there's a few different categories of states that we see. We have in turquoise there, it's states that already had a sales tax requirement for for direct-to-consumer shippers. And regardless of their economic nexus status, it's written into the direct shipper statute. So that's all of those teal states already had a sales tax requirement. In green, we have the states that have a winery tax unique tax rule. And so we see that with Wyoming, we see it with Kansas, it looks like West Virginia and New Hampshire there. So that we had mentioned previously, there's states in orange there where either there's no sales tax or direct-to-consumer shipping is not currently allowed. Really the two key ones where direct-to-consumer shipping is not allowed are Utah and Mississippi, though Arkansas, Rhode Island, and Delaware allow it provisionally based on if it's an on-site purchase. there isn't typically sales tax associated with those. And then Alaska, there's no state sales tax, but it is a local option state. So next, I'm going to hand it off to Sarah to explain a little bit more about what economic nexus is and how that may impact you.
Awesome. Thank you, Shannon. I think what you really did was highlight the differences in requirements for this industry. In other industries with all of these new laws, sales tax is it. We don't have all these extra reports and extra reporting. So it is so much more complicated and complex in this industry. And so I really love how you walked through each of those different types of requirements, because it can really be confusing and complex. So just to dive a little deeper into economic nexus, in many states, this did not have the same impact on wineries making DTC shipments. Most states, including the plaintiff state, South Dakota, were already collecting sales taxes on wine shipped to their consumers. Sales tax payment has been a provision of most of the DTC shipping laws that have been implemented over the past 30 years, and wineries have already learned how to comply with such requirements. That said, the 3-year journey of economic nexus, 3 or 4-year journey now, I'm not sure. We're getting on 4 years now, resulting from that decision has reached maturation, and now all 45 states that collect sales tax have economic nexus laws. This includes states where it may not have been required previously. And it could add some complexity to the return filing, which is my cup of tea. Return filing is what I do. So the first step is always understanding where you may need to collect and remit sales tax, and it may not need to be collected everywhere. Some examples of the jurisdictions where there is additional complexity are Colorado and Illinois, where now if you meet the economic nexus threshold, your filing requirement just got more complex. It's required to file location, or what they call destination-based filing, which is an additional tax that you have to pass on to your consumers. So most states require it already for DTC, but those that didn't now do, except for those couple that she pointed out. And then my fun fact, which Shannon already alluded to, is that Alaska does not actually have a state sales tax, but the local governments got together and adopted the economic nexus laws as well. And we're going to hear more about the legislation that's going to pass in 2024, which could also affect direct consumer sales. Next up, I wanted to talk a little bit about one of my favorite topics, which is marketplace. So just for a little background, a marketplace is a physical or electronic place, including but not limited to a store, a booth, an internet website, catalog, dedicated sales software application, where tangible personal property, digital codes, digital products, services, and wine are now sold. So if you think of Amazon and Etsy for an example, not necessarily for the wine industry, but those are examples of the marketplaces. A marketplace seller is a seller that makes retail sales through any marketplace operated by a marketplace facilitator, regardless of whether the seller is required to be registered with the state or not. Almost all states have now implemented marketplace laws. Actually, I think we might be, Missouri might be the last one, as Shannon alluded to before. You could still have a requirement to register and file. So even though the marketplaces are now required to remit the sales tax, you may still have a requirement to file a sales tax return with the sales that you collected. Maybe not remit the tax, but with the sales. Depending on your industry, even if you make sales solely on a marketplace, you have that obligation. Direct-to-consumer wine companies are required to file sales tax returns even if they are selling solely on a marketplace. So what does that mean? In states like Washington, if you meet a certain threshold, you still need to register and remit business and occupation taxes, also called B&O. So marketplace might remit the sales or the tax that you are collecting, but you're still going to have that requirement, and that can be really cumbersome to have to track all of that. To add to that, if you have direct sales and marketplace sales, then you can have special reporting requirements. Certain returns actually require you break out the direct sales versus the marketplace sales on the same return. Other returns are not as complex, but as Shannon has been saying all along, every state is different and keeps you on your toes. So it's really something that is hard to manage and hard to track, and has been one of the most interesting introductions since economic nexus thresholds and marketplace sales at the same time. Keeping track of both can be really cumbersome for a business. Next up is a topic that is near and dear to my heart because I've led a returns team for over a decade, and it's managing returns deadlines. Could sound simple, but it is probably the most complex thing for a business, especially in this industry. While working with businesses that are making a transition from filing returns in-house to Avalara, many use Excel to track the list of reporting jurisdictions and due dates, as well as calendar reminders. Most jurisdictions actually require electronic reporting, no paper filing. They'll actually throw away your return if you send them a paper return. So it's super important to keep track of online account login credentials, website URLs, part of your master filing calendar tracking report. This all might sound very simple, but it's not when you're filing, when you're moving into new states and have to manage all those different types of requirements. Most jurisdictions actually now also require authentication upon login these days. So what we find is just simply tracking down the owner of the original website logins is actually really complex if it's been moved around across multiple people and businesses. So having some kind of filing calendar tracking sheet is one of the most important things when it comes to filing, because if you miss those deadlines, you'll surely be increasing penalty and interest possibilities. Jurisdictions are also sending notification of changes in reporting, such as frequency or prepayment requirements, and we have to make notes of those every single time. Making note of the effective date of the change, because penalties and interest will be assessed if you do not meet the updated requirements. Filing deadlines vary by state and by form. So all of that is so hard to manage, and if you're moving your business to online, and so it's really something that we've seen one of the biggest struggles that we've seen with companies that begin to sell online and sell direct to consumer sales. The filing deadlines vary by state. Some are as early as the 10th. That is so close to the end of close of your business for the last month that is so hard to manage. So do prepayment deadlines, thresholds, all of the things that Shannon was kind of covering a little bit. It's one of the reasons that makes this industry so interesting, but also so complex, right? Because states like Illinois require weekly prepayments once you meet a certain threshold. Back to that fun threshold tracking that can be very hard to do. Other unique examples, Arizona has a different deadline for return and the payment. Washington has a different deadline depending on the frequency. So as you increase your sales, you're increasing the complexity because you're constantly changing your deadlines, constantly changing the need to have a really good management of your filing calendar is what we call it internally. But but on a positive note, many states are kind enough to offer timely filing discounts if you file on time. So you really want to take advantage of that where possible. So you can actually get a discount on the sales tax collected and get some money back for just filing on time, which is wonderful. And so next up, I just wanted to cover a little bit on managing return filings. Similar to the previous slide, some businesses partner with their accounting firms or trusted service provider like Avalara to prep and file sales tax returns. Providing the necessary tax data and filing information is the handshake in the process to enable filing and remittance. If you're filing return in-house, it's important to set aside the time each month outside of the process of filing returns to keep up with jurisdiction updates and changes that impact your business. which is what Shannon does wonderfully for our team. Form changes as well as online filing changes are so common. In the last couple of years, I can't even describe how many changes we've seen just to online websites. And they happen at the last second. So right before you go to file your return, suddenly website changes and you have to figure it out and get that filed on time. That's next to impossible sometimes. Staying ahead of the due dates also allows you to take advantage of those timely filing discounts and avoid penalties and interest for filing late and having late payments. Keeping track of internal changes that can impact these is also super important. If your business has a change in a bank account, every single online account has to be, you have to update your bank account. These all sound very simplistic, but it's very complex when you are filing in every jurisdiction that across the United States. So these are all the things that require time, tracking, and all kinds of different considerations. So there's a lot to consider as part of sales tax registration and reporting requirements for every business. Definitely requires setting aside the necessary time. Businesses are expanding into e-commerce options all over, which lends a new form of complexity. If I've ran a sales tax team for a very long time. Beverage alcohol introduces a whole new set of complexity. So it's really important to understand all of these different pieces that go into this type of reporting. Your business must keep track of Nexus obligations, physical and economic, track filing frequencies, online logins, prepayment requirements, be sure to aggregate data sources and all the necessary data, which is lots for the beverage alcohol industry. Allocate across state and local jurisdictions, manage your reporting requirements of selling on marketplaces, and keep track of the vast list of changes across jurisdictions in order to accurately file your returns on time and on the correct form. So that's a mouthful, but it is also why I love what I do. The ever-changing, it keeps us on our toes, ever-changing environment. But Avalara is actually a great resource to offload the high cost and hassle of those returns. And so with that mouthful, I think that's a wrap. And we have some resources that we are going to send out. And I would like to thank you for allowing Shannon and I to share with you on our favorite topic, the beverage alcohol tax ecosystem. Shannon, unless you have any more to add, I think we're...
No, thank you everybody so much for coming today. We really look forward to your questions and chatting with you. If you want to learn more about Avalara, you can click on the link there and reach out. We're more than happy to answer your questions.